Hello and welcome to Before the Market on Pride Television. Reaching you from Lagos, Nigeria, my name is Joy Onka. From Nigeria, equity transactions on the floor of the Nigerian Stock Exchange started the week on a downward note, following price losses recorded by most blue-chip stocks, even as market capitalization plunged by 143 billion naira. At the close of transaction yesterday, the market capitalization of listed equities depreciated by 0.9% to 14.6 trillion naira from 14.7 trillion naira recorded on Friday. The all-share index, which measures the performance of listed equities, slid by 0.9% from 40,920.7 to 40,533.3. On the top gainers chart, Seplat Petroleum Development Company led the table with 3.95% to close at 698 naira 3 kobo. Others on the chart were Nestle, Unilever, Oando, and GlaxoSmithKline. And on the losers chart, Mobil led the chart to close with 5% loss, and others on the chart were the Nigerian Breweries, Presco, Access Bank, UAC Property Development PLC. It's still the Before the Market. We'll go on a break, and when we return, we'll bring you more stories from the stock market. Do stay with us. The Nigerian Stock Exchange has announced the migration of Access Bank PLC, Lafarge Africa PLC, Seplat Petroleum Development Company PLC, and the United Bank for Africa PLC to its premium board on Monday, the 16th of April 2018. And this is sequel to the application and meeting of the exchange listing requirements for the board. The Premium Board is a listing segment for the elite group of issuers that meets the exchange's most stringent corporate governance and listing standards. Access Bank PLC, Lafarge Africa PLC, Seplat Petroleum Development Company PLC, and the United Bank for Africa have all passed the corporate governance rating system and have market capitalization of 347.12 billion naira, 378.60 billion naira, 391.37 billion naira, and 374.48 billion naira, respectively. The stated companies have joined Dangote Cement PLC, FBN Holdings PLC, and Zenith International Bank PLC, who were migrated to the Premium Board in 2015, and bringing the total number of companies on the board to 7. We'll go on another quick break, and when we return, we give you our forecast for the day. To stay with us. Welcome back. And now to our forecast for the day. We expect market performance to remain upbeat on account of increased bargain hunting. And we also expect these stocks to perform brilliantly, relatively well during this market. And that's May and Baker Nigeria PLC, Oando PLC, Seplat Petroleum Development Company, and FBN Holdings. And that concludes our preview of the market on the program. Thank you for joining us on this edition of Before the Market. And coming up at the top of the hour is a global business review where we shall take you through a comprehensive look at the big headlines from the world of global business. And do remember to follow us on all our social media platforms and subscribe to our YouTube channel at Pride Television. Till next time, it's bye for now. My name is Joy Onka. the trending global news on business. Trump hammers Amazon with United States Postal Service rates review. Disney to buy Sky no matter what. Konga and Udala merge. Hello and welcome to Global Business Review on Pride Television, reaching you from Lagos, Nigeria. My name is Joy Onka. E-commerce giant Amazon seems trapped in what looks like an ambush by the United States government on the U.S. Postal Service rates review. And I'm here to analyze and examine angles to this developing story is VWS analyst and business correspondent Lekan Fakoejo. Lekan, you're welcome.
Thanks so much for having me.
All right, Lekan, Amazon is currently the world's largest retail company, like
of course
we all know, and it is the 5th most valuable company in the world.
Definitely.
And right now he's having what we would call a it's a personal battle between him and the president of the United States. But before we go into that story, let's consider Amazon. Give us a brief background to Amazon as a company, its key players, and the industry it's operating.
Okay, well, Amazon was established in 1994 by Jeff Bezos, and it was established because Bezos' hope, or should I say plan, was to have the largest or biggest bookstore in the world, which is definitely what he already has right now. But along the line, over the years, he decided to expand the business to go into other sectors, other industries as well, which took Amazon. The reason why Amazon started dealing in media, electronics, grocery stores, and other sectors like that. Few sectors which are not known to many people, though. Well, when it comes to the media, don't forget that Amazon also has Amazon Prime, which is the entertainment. They also have IMDb, which is also a form of entertainment for them, movies, television, and celebrity news. They also have Twitch TV. They also have Amazon Prime instant video as well. So he has been able to expand his business from being a bookstore to being a company that also operates in electronics, because they also sell electronics. They have Alexa, they have Echo, which other form of business which Amazon also deals in. They also have they're also in general works as well. Don't forget that they export and they sell clothing as well. So Amazon is no more a bookstore, which it started as, but now Amazon is in the media, is in the electronic sectors, Amazon is now a home for everything. There's nothing you want in your home or as an individual that you won't get in Amazon. Now, talking about the industry which Amazon it finds itself now. Amazon is in an industry that is quite difficult to. It has few competitors, and it's quite difficult to go into and also exit due to the barrier level, the entry barrier level, and the exit. And I'm talking about no other than the oligopolistic industry. It's capital intensive. It's an industry that needs a lot of cash investment. You don't just come in and decide to start a business without having it at the back of your mind that, you know what, I have this cash, I have this support, I have this investment on ground first. Bezos left his work as the vice president of Shaw & Co. in 1994 to start Amazon. He didn't just leave. He wasn't just an individual without a source of income or without plans. He had this plan, and you know what, he went for it. So this industry requires a lot of attention, requires a lot of finance as well. So the industry is quite high. There's an edge. The entry barrier and the exit barrier is on the high side. So it's expensive compared to being a monopolistic industry.
All right, Lekan, now, Amazon being the world's 5th most valuable brand,
yes,
how does it pose a threat to United States taxpayers?
Well, for me, Amazon is in what way, due to the deal they have with USPS, and that's the United States Postal Service. Many people believe, or should I say Donald Trump, the president of the United States, believe that it endangers taxpayers, because what Donald Trump says he's trying to avoid is taxpayers making use of taxpayers to bail out the USPS, because Donald Trump believes that the USPS is heading towards a financial path that is wrong. And he doesn't want, at the end of the day, they would have to make use of the revenue or the taxpayers' money to offset the loans or the debts of USPS. That's why Donald Trump has decided to, create a task force which will be led by the Treasury Secretary, of course, Stephen Mnuchin, who would lead it, and within 120 days, of course, we would find out the results. But he believes that this deal, because the deal between Amazon and USPS, he says that they are paying lesser than they would pay other competitors. Like we have UPS, we have FedEx. So, and don't forget that UPS once accused UPS that they accused USPS that they are they're undercharging Amazon because they don't want other companies to also get a stake or have more stake in the e-commerce or delivery business, I mean. So this is why many people, why Donald Trump believes that it poses a danger to taxpayers, because when they have to rely on Amazon, when they have to rely on Amazon's money, despite Amazon paying less, it would affect them, because Amazon is not paying as much as they would pay other delivery service.
All right, Lekon, now based on your analysis of this whole issue now, what is your SWOT analysis on Amazon in retaliation to these new developments by Donald Trump?
Whoa, that's a good question. Right now, this new development from Donald Trump, it shows that right now it's a threat. Right now it's a threat. Very soon it will become a weakness, because there's nothing Amazon wants to get from this. There's no opportunity Amazon wants to get from this. The opportunity Amazon had, or should I say have correctly, is that they are paying less than they would to other delivery service provider. They are paying lesser to United States Postal Service. So right now, this new development has created a threat to this, because don't forget that this is also contributing or helping Amazon with revenue-wise now, because they don't have to spend so much on operating costs, on delivery costs. But once Donald Trump goes ahead, or the lawmakers support Donald Trump on these arguments which he is currently having now, once they go ahead with it, it would affect. So right now, that's just it's quite much anyway.
All right, Lekon. Now, the United States government has set up a task force that will examine business as far as the postal service is concerned, and that he also says it has lost its monopoly. Now, do you think this is necessary in this case? And considering the fact that he says it has lost its monopoly, how do you think the U.S. Postal Service has lost its monopoly in the United States market?
Of course, definitely they believe that it has lost its monopoly, because it's now dependent on Amazon, because Amazon is one of the biggest clients of the USPS. And don't forget that when it comes to Amazon, Amazon in 2013 now, for instance, they went into a deal with the USPS that, which is a secret, which the talks, or should I say the contract, is not known to the public. It's a secret right now. Now, they went into the deal, and they know that, when we go into this deal, it's going to help us, right? Now, when they continue with such deal, it's going to affect a lot of people. It's going to affect a lot of people. For instance, now, let's say, for instance, I mentioned, for instance, for the competitors. I said earlier that they accused, what is it called? They accused
Amazon.
No, they accused USPS that they are charging Amazon. Now, these people have the monopoly, because, or they don't really have the monopoly, but they have more stake in the industry, because they are private sectors. Now, but because the USPS is depending solely on Amazon, they are losing financially. Despite, because let's forget that letter volume has dropped over. Despite them having consistent deals with Amazon, they have still lost, over the years, they've always recorded net loss, for 11 years now. And with the most recent being the $2.7 billion, the loss in 2017. Now, if they keep going this way, Donald Trump believes that they will not have the strength that they used to. this is a government agency that should work well, and Donald Trump believes that once they get it right, once they are able to get the payments right, which is also one of the factors in the review, once they are able to add probably something like 15% or 20%, it will add $400 million to Amazon's operating costs. So that would help the United States Postal Service. It will help them revive financially, it will help them stand financially, and that would also help them in job-wise. That means they'll be able to pay their workers better, they'll be able to expand their business, and they'll be able to serve the public better, rather than going on this financial part, which Donald Trump believes that it would end up becoming a bad business for USPS, and that is what Donald Trump is trying to avoid. He's trying to regain. Don't forget that he's saying that he wants to put America first. So, which means that everything that has to do with America, including the business of the government, he wants to put it back to where it belongs, and he wants them to begin to compete with even private companies who are in the postal service as well.
All right, now, Lekon, now how will the U.S. Postal Service rates review affect Amazon, especially in the short to medium term?
Well, like I stated earlier, that according to Source, one of their analysts, it says that this review might end up seeing the review team, the task force, probably increasing the postal charges by 15% or 20% within that range. Now, if they do that, it will add 500 what? It will add 500 for over $400 million. I mean, to Amazon's operating costs. Now, if they do this, which means that Amazon would have, at the end of the day, Amazon would have to add probably 20% increase to their Prime, to Amazon Prime. That's to users in the North America. So that's where, you know, when now, take for instance now, Amazon doing that, when they have their Prime, Amazon Prime is currently $99. Now, it's a bargain for their users. But if they have to increase it, it will affect their subscribers, because now subscribers might now start moving towards their competitors. Now, that's when it comes to affecting Amazon. But when it comes to the plans that Amazon might have, Jeff Bezos is tight-lipped on this case right now, because he hasn't given much insight or haven't reacted to it as much as many people would love to. Because right now, people are saying it's probably personal grievances between he himself and Donald Trump. Don't forget, Donald Trump is believed to be the world's the president of the strongest nation in the world, while Jeff Bezos is the richest, seems to be like the richest man in the world. So this is competition. People believe that it's financial battle, and when they keep going this way, Amazon have not revealed much about what that they would do to what Donald Trump is currently taking up now, because the lawmakers are focusing on Facebook currently. But if Donald Trump succeeds in this rate review that is currently going on, if he succeeds, probably Amazon would have to, in order to offset the costs, because it will grow by $400 million, in order to offset it, they would have to increase prices of certain things, because when Amazon bought Whole Foods as well, they reduced the sales of some of their items. So they'll probably have to increase it when it comes to Amazon Prime as well. They'll have to increase it as well. That's the prices now. And that would probably affect them in some way. So at the end of the day, it's probably going to be a lose-lose for Amazon. But at the end of the day, they will still revive and bounce back.
All right, thank you very much, Lekon.
Thanks so much.
Thank you for your insights on the topic. We hope to have you back as the story develops.
Definitely.
All right, it's still the Global Business Review. We'll go on a short break, and when we return, the story continues. Welcome back. You're still on to Pride Television, and this is the Global Business Review. Now, global mass media colossus Disney is to buy Sky no matter what. This seems very likely that the Rule 9.1 of the United Kingdom takeover code may be brought into effect very soon. And to discuss this with me, we have VWS correspondent and analyst Paul Onelum, who's here, and he'll be analyzing this transaction with me. And Paul, you're welcome.
Thank you so much. It's a pleasure.
All right, Paul, the news about Disney's purchase of Sky is a bit confusing and at the same time interesting.
Definitely.
So can you give us a background into this story now? Tell us what is the market structure of Sky as a company, and then what kind of what industry does it operate in, its key players, and its revenue source?
All right. Sky is a very big company, owing to the fact that it has over 23 million viewers, and they also subscribe. And now, looking at the sector, it belongs to the masses business. We also consider that it is it has a lot of, you have to get a lot of money to be able to invest in such kind of business, because it has a high capital regulation that everyone has to consider if he wants to venture into such business like that of Sky.
All right, now it's obvious that Sky finds itself in a very competitive industry. Mm-hmm. And then you will recall that Disney, Comcast, and Murdoch
yes,
also showed interest
yes,
to get Sky.
Yes.
So it's like Sky is the
limit. Sky is just high.
Everybody wants Sky right now. And then if you recall, Comcast offered 22 billion pounds just for Sky, yes, while Murdoch has offered his Disney's 39% stake in Sky now. Now, while trying to buy the remaining 61%. Now, why is Sky so important if everyone is coming up with such huge amounts to get Sky?
All right, you agree with me that Sky is the largest TV operator even in UK. It's largest pay TV operator even in UK, owing to the fact that it has over 22 million users and subscribers. And annually, statistics have made us to understand that they make over 2 billion. They make over 2 billion euros every year. Now, looking at Comcast, you agree with me that the US media, they're having this little growth, which is a little bit dramatic. And looking at Comcast, if they can get a deal from Sky, automatically Comcast will be one of the largest paid TV industry even in the world today. And owing to the fact that looking at the slow growth of Comcast, outside the US affairs and its revenue, it has about 9%. So if they invest, or if they try as much as possible to get Sky, it will skyrocket even up.
On the final note, Paul, now let's look at the 9.1 code of the United Kingdom. And then we also have the takeover code that companies are normally forced to take up to 30%. Now, Disney does not look like a company that would want to have a gun put to its head and be forced to take over Sky as a company now. How is this complicated, and what does this mean for investors in the TV and viewers alike?
All right, this is a very interesting question, and I really love this a lot. Now, if we look at Murdoch's move, like I said earlier when I was asking the second question, I said Murdoch has about 39%, even part of Sky, and now he's willing to acquire the remaining 61%. If the market structure, or if the industry or the regulators approves this move for him, automatically he has the 100%. And in one way or the other, Murdoch will be willing to give the 100% to Disney. And automatically, when Disney gets this, automatically it goes high, owing to the fact that Murdoch's role, even in Sky, has made the football league from being a normal premium football league to an entertaining football league that everybody wants to subscribe onto. And owing to the fact that Sky doesn't just allow their viewers to just come and watch or pay to watch, but now you can as well buy board brands and every other interesting platform through Sky. This is why it's so interested for them to go to make waves even in the industry.
All right, thank you very much, Paul. I realize that it's still a developing story, so
yes,
when next we have stories on this, we'll definitely call on you.
Thank you so much.
Thank you for joining us on this edition. All right, we'll go on a quick break, and when we return, we look at the new Konga.com, so do stay with us.
Nigeria, the e-commerce space, we have looking at the advent of Waka Now. Waka Now since Udala rather, since 2008. You know, it has been in place. Then it was trying to evolve, trying to grow. Then later on we saw the advent of Jumia and Konga. Now Jumia and Konga came in 2012. Still trying to bring in competition into the industry. Then before we now have the likes of OLX, GG, everything, Slot, Deal Day, and the likes. So with the way we have more competitors or more players in the industry, definitely the industry is expanding and very, very large. Yes. Okay,
now with the industry expanding and becoming large, as you have said, now what prompted this merger between Konga and Udala, and what is its effect on the Nigeria's e-commerce landscape?
Okay. Excuse me. Okay, the merger between Udala and Konga. Now, let's not forget the fact that since Konga's being founded in the year 2012, when it came out, they were being financed by a foreign company, the investors, and that is Kinevik. Now, Kinevik invested with them over since 2012 down to 2016. And with that, Udala is being owned by Prince Nnamdi Eke, that's the son to Xenos Technologies, Stan Eke. Now, with that, the issue of profitability took over, came to Kinevik, and they were not making, the expected profit which they were supposed to make. So they decided to withdraw their investment from Konga. Now they withdrawing their investment from Konga. Now looking at it, still with the key players in the industry, having Jumia, having Konga, Udala is the third largest retail shopping mall in Nigeria, after Konga and Jumia. Now with others also in place. Now when they withdrew, with the level that Konga has attained, it is not a good thing that, though being an investor, you must make profit from whatever investment you're making. So after they withdrew their investment, now Udala saw this and like, okay, Konga has a customer base. If you look at the market share, in Nigeria, Jumia has like 46% of the market share, and that span also across about 22 countries in Africa. While Konga, is just an online, shopping mall, and they are mostly Lagos-based. But Udala is both online and offline, in which they have many outlets across Nigeria. So with this, Udala thought of it and like, if we can combine with Konga, their investors now have withdrawn their investment, and we can't just allow them to die off like that. Let's still retain their customer base which they have. So let's merge with them, and the merger came up, and it's going to take effect from 1st of May 2018, and that is what has prompted it. So with Konga and Udala coming up, as one force, now they want to take over dominance in the e-commerce space in Nigeria, and with that, they will become a reckoning force.
Okay, and now let's look at Konga as a company.
Okay.
If you were to analyze Konga, what would you say is Konga's SWOT analysis?
Okay, and for Konga, one of the strengths which they have is the number of customers which they have. After Jumia having about 3 million subscribers, in Nigeria, then Konga is having like half of it, But with them having half of it, it still portends that they have this kind of experience which they give to their customers. So that counts as a strength to them. Now, the other side to it is that for Konga is that they are limited in the sense that they don't tend to expand around Nigeria, though you can make your orders anywhere you are in Nigeria, but they decide to make it like simply Lagos-based. And looking at the kind of products which they offer to their customers is mostly range from electronics to household appliances and even clothing. But Jumia or Udala, on the other hand, they decide to diversify into various areas, in the retail industry. And now the opportunities there for Konga is they have given various merchants, more than 1,000 merchants, the opportunity to sell on that platform and make money. So definitely they are creating, more businesses, creating employment, for everyone in the country, in the economy. So with that, we can see the rate. They having a market share of 32%. Excuse me. The financiers, which they also have, NASPIAS, which is the South African leading group, also, they finance OLS, also they finance everything.com. Now, these people, they decide to pack up everything. I think they say owing to the cost of doing business in Nigeria. Commerce industry in Nigeria will still gain momentum, within the short while, because now the way the foreign exchange is now stable and everything now, more investors will now come into Nigeria to, invest into these businesses just to move it to the next level, which it's also to be in Nigeria because it's actually growing well.
Okay, speaking of it, moving to the next level, and with the merger between these two companies, yes, and then with Udala's 2020 projection for its company, do we now say that the e-commerce sector in Nigeria is finally on a path to, do we say it's on a path to success or profitability, considering this merger now, which takes place from the 1st of May?
Okay, for me to answer that question, let's look at the story of Hulu and Spotify trying to come together to also gain force and compete with those who are already in the music and video streaming business, and they are trying to come together to form as one to also compete. This same thing goes with Udala and Konga. They're coming together now. With two of them, not that one is higher, one is lower. They are actually following themselves. Udala is following Konga in terms of market share, in terms of profitability. Now, with this merger that has taken place, well, I can say that the industry is, moving towards the point of profitability. But looking at it, when Konga, when the owners of Konga and Carnegie were trying to, when they came out with a report, that was 2016, saying that they are not really making that profit which they ought to make. Let's not forget that same period also, within 6 months, Jumia made a loss of $61 million within that same period. But still, they still continue. Now, with the merger between Konga and Udala coming up, Konga has this projection that by 2020, they want to be, the foremost company or e-commerce company in the industry to have attained a sustained profitability by year 2020. So with that, they're working towards that goal with the vision, and they're joining force with Konga just to move the retail business or e-commerce business to the next level. Then also with the expectation that more investors will still come in and they'll pick up also to join us to raise GDP or revenue within the industry. We can say that the industry is actually on the path to profitability and to sustainable development. Yes.
Okay. On a final note now, let's look at this. We know that Udala's parent company is Xenos.
Xenos, yes.
And then with this merger between Konga and Udala, let's also look at their 2020 projection to be the foremost in Africa.
Of course.
Do we see a merger between Konga, Udala, and Jumia in the nearest future?
Well, it will not be a bad thing, but one thing I can say is that will be a part of the three coming together to move towards monopoly. Because the way it is now, it's very, very competitive. The competition is so stiff and interesting. Everyone is coming up with different ideas, launching with the Jakarta show, the Black Friday, and the rest things. So the competition is getting so intense and very stiff. Now, if Konga and Jumia coming together with Udala, the three of them as a force coming together, Jumia having 46%, Konga having 32%, Ujola having 21%. The two of them combined like 99%. That is monopoly. Now, with that coming to place, though in a country like Nigeria, monopoly is not a bad thing because we operate the mixed economy, and it's also allowed, with the capitalists and everything. So they're tending towards monopoly. It's actually going to give, those who are having the mind of coming into the industry, it will now give them this fear factor that if we come here, this dominance is too high, we can't compete, and definitely that they will now withdraw. So looking at the cost to which they will have to put in to come in and compete, because it's capital intensive, So looking at that, it will give the about to be investors into the market that fear that we can't compete with this force having like 9% of the whole market. What are we coming to fight for? So it will move towards monopoly. But in the long run, I think it might happen. Yes. You
think it might happen, or you think that it would scare off other investors who are interested in coming into this e-commerce landscape?
That is one thing that will make the business to be more interesting because though the competition is still good, but coming together, you're not looking at the fact that your SWOT analysis as a holding, this is the part I am not really getting it, this is the part I am getting it. So me coming together with other forces who are already into the business, then we can achieve something. So there's the possibility of it happening.
All right, thank you very much, Charles, for your insights on this topic.
You're welcome.
And that concludes this edition of the Global Business Review. Do remember to follow us on all our social media platforms, and do not forget to follow our YouTube channel. Thank you for joining us once again. My name is Joy Onka. Till next time, it's bye for now.
Both left and right, front and back in Nigeria. No, that thing are moving very, both economy, everything, nothing move well.
The situation of this country have made everything to go high. Now we are in time of change. During corruption, thing was so low, but change brings something too high. So I really understand the meaning of the change now. Many people in the jeopardy because their business are not going as before. People have sacked from work. People have lost their main life depending on the situation of this country. So human beings are not happy. Totally, this country, we are suffering.
Somewhere last year, around this time, we saw per mango, 20 naira. But this time around, it's 200 naira. So everything is going higher and expensive. So that is what I can say about this economic growth. That's what I can say about it. 20
naira, no, I'm no more seeing 20 naira notes.
Okay, what about 15 naira notes?
15 naira is scarce too, even 100 naira. All the 100 naira that is available, all is dirty and tough. It's not useful again to be used.
Nothing will fine at all. So if I'm here as an old man to open my mouth and explain and tell you what's going on, people will criticize me, people will not happy. So let us just swallow it and wait for the time the Messiah will come.
The richest man in the world came to tell us about our priorities. He's wrong now. So we should have listened to what the man was saying. I mean, Bill Gates. So see what he told us. So, but our leaders don't listen to anything like that. Well, I think I've spoken enough.
Hello and welcome to Sports and Money, the only program that provides you with insights and comments on the money side of sports. My name is Emmanuel Akindabua. Today on the program, we'll begin a series where we'll be taking an in-depth look at the revenue profile of some of the world's biggest football clubs. We'll be asking which clubs makes the most money, where does the money come from, and what does this mean? Coming up, we'll take a look at the bid by the new owners led by the Liberty Media Group. But first, a rundown of some of the major sport and money news making the rounds globally. In a setback to its sport and tourism economy, South Africa lost its bid to host the 2023 Rugby World Cup to France. And France says it expects strong economic growth from hosting the 2023 Rugby World Cup and the Summer Olympics the following year in 2024. Financier Amanda Staveley has tabled a former offer of up to £300 million for Newcastle United, and a move that values the Premier League football club below the sum sought by Mike Ashley, its entrepreneur owner. Now, after the break, we find out where does the money come from in football and what does this revenue streams mean for the future of the club side. Stay with us. It's still sport and money. According to the 2017 Deloitte Football Money League, we compiled a list of the top richest clubs in the world based on match day revenue. Let's have a look. Manchester United topped the Deloitte Money League for match day revenue in 2017 with a total revenue of £102.8 million ahead of Spanish powerhouses Barcelona and Real Madrid. But how were Manchester United able to muster such a huge revenue based on an average attendance of 75,327 compared to Barcelona's huge match day turnout of 79,724. Joining me to discuss this and to take an in-depth look at the revenue profile of some of the world's biggest club side is Toby Adesina, a digital sports broadcaster and analyst at Voidant Wire Service. Welcome to the program, Toby.
Thanks for having me, Manu.
All right, so Manchester United toppling Real Madrid as the biggest club in terms
of mats, and then we also have supermarkets owned by the brand itself, Manchester United, in Old Trafford, where fans can come in and purchase things. So all these things accumulate.
So it's more about the merchandise, the brand power of Manchester United. Let's look at the top teams in this ranking. Manchester United, of course, with a huge income of £102.8 million, followed by another English powerhouse, Arsenal, are second with a total match revenue of £99.9 million. You look at these two club sides, Arsenal not really successful in the domestic league where they finished in 5th position, but yet they boast of a huge turnout in revenue.
Yes, when you look at English Premier League, the match day ticket is very pricey in England compared to other leagues of the world. And when you compare the English league to that of La Liga, it's a mild different. We have a match day ticket, for England at £45, while in La Liga it's for £28. That's like a wide ocean.
Almost twice the amount of what is payable in England.
That's double figures for you. Double figures compared to what you have in La Liga.
All right, Barcelona, of course, are in 4th position, while European champions Real Madrid boast of £96.5 million as match day revenue. Of course, Real Madrid play the home games at the Estadio Santiago Bernabeu. German champions Bayern Munich had a revenue income from match day of £76.1 million. Now let's compare the English Premier League, the Spanish La Liga, and the German Bundesliga. The disparity in the figures. German on match day, we see a lot of turnout, especially at the Signal Iduna Park where Borussia Dortmund played, as well as the Allianz Arena where Bayern Munich played. But looking at the advantage, what advantage does English clubs have over the Spanish club as well as the German club when it comes to match day revenue? It's
the ticket pricing, Emmanuel. When you look at the German Bundesliga, they have 10.8 pounds for an average ticket holder. We have to pay for a match day ticket. And then when you look at La Liga, it's £28. When you look at the English Premier League, it's £45. That's like double of what you have in La Liga.
What you have in the other big league.
Other big leagues. Now, La Liga is like the closest to the British league. And the England league is the most expensive league where you can get ticket pricing ever. When you look at Arsenal has the most expensive ticket price in England. We have close to £78 per week. And then that's huge in terms of revenue for a club like Arsenal.
Okay. And if you look at the top 10, you would discover that we have 5 English Premier League club sides in the top 10. Of course, Manchester United in the 1st position, Arsenal in 2nd position with £99.9 million. Of course, we've got Chelsea in 6th position with £69.7 million on match day revenue. Liverpool in 8th position with £56.8 million as match day revenue. And Manchester City, £52.5 million as match day revenue in number 9. Would you say the competitive nature of the English game is also yielding results in terms of income?
Yeah, you have to ask yourself, what do you mean by competition? Is it the branding you're looking at, or the rate at which you see changes in the top 5?
In England, we've got the top 6. Arsenal, Chelsea, Manchester United, Manchester City, Tottenham, Hotspur, Liverpool. In the La Liga, perhaps it's just Real Madrid, Barcelona, and the rest. Perhaps you may want to include Atletico Madrid as well. And of course, we'll see you anytime soon on the other subsequent episode of the Money Series.
The pleasure is all mine, man.
All right, when we return from the break, we'll discuss the business of Formula One and why it was purchased by John Malone and his Liberty Media Group, and what are the next steps in increasing the existing commercial value of Formula One. That's right, after this timeout, the program is still Sports and Money. Stay with us.